Hi there, it's Mike Wise, CMG Home Loans, and I'm going to go through this video with you and explain out the all-in-one loan for you. So this may give you a little bit different of a picture of the all-in-one loan and how it actually works. It's a PowerPoint presentation. It may have some word pictures. It may have some screenshots that help maybe it click in your head as to how this loan actually works. So it's going to take about 15 to 20 minutes to go through it. Let's get started and see how this works for you. So I'm going to be looking over here to the side every once in a while because this is where I have my computer and going to be showing you this presentation. So the all-in-one loan, it is a loan that's only offered by CMG Home Loans. It's something that we developed in 2005, and so we've had it for 20 years. Zero delinquencies, zero foreclosures on it. Borrowers love this loan. They love it so much, and they're doing it more and more. In fact, people have more than one all-in-one loan. We do it on single-family residences, condos, 2 to 4 unit properties, and we do it on purchase, refinance, cash-out loans, as well as offer it on primary residence, second homes, and investment properties, and loan amounts up to $3 million. Now, I've seen loans actually go above $3 million, so if you do have buyers that are looking for more than a $3 million loan, we can look at that transaction for you as well. Now, why are we going to reimagine this mortgage? Look, it's the 30-year fixed rate mortgage. It's been around for many, many years. It's been around since the 1930s. This loan came out of the Depression when we were only offering adjustable rate mortgages. And when those adjustable rate mortgages came out, there was a lot of inflation at that point in time. And as that inflation came out, interest rates went up, the cost of housing went up, and we had to foreclose on a lot of houses in the 1930s. And this was just a part of the whole Depression era. And out of this came the 30-year fixed rate mortgage for people to basically lengthen out their time frame of buying or of paying back the mortgage and keeping their rates the same over that period of time. So look, they play a huge piece in the market today. It is what people use as a 30-year fixed rate mortgage. They use that to buy a house. 84% of the people that buy a house, they need to have a loan of some sort to buy this house. They don't just have $1 million sitting around to go out and buy $1 million house. So they need a loan to help them get there. And 62% of people have a mortgage on their house of some sort. So it plays a huge piece in the economy. Now, the borrowing costs play a huge role in this, right? The 30-year fixed rate mortgage, it really depends on where interest rates are. In today's market, interest rates are high, and so the housing market has slowed down. It slows down the whole economy when interest rates are high. When interest rates come down, the market speeds up, there's more activity, there's more loans, and it goes a lot better for us in the mortgage world because there's more people buying houses. Now, NAR has a specific statistic that they use, and that statistic is this, is that for every 1% that the interest rates come down, there's 5 million more people that can now afford that house. So as interest rates go down, it gets more competitive. As it gets more competitive, then the values of homes start to go up because there's more demand and less supply out there. So it has a huge impact as far as the borrowing costs are concerned, right? So to offset those costs, right, borrowers, we choose that lengthy term, that 30-year amortized payment, because that gives you a lower payment over those 30 years. Now, interest costs are all up front, but this is how we do it and how we get the payment lower for you to go out and buy a house where it's more affordable, but it takes 30 years to repay that mortgage payment. Now, there's a huge piece of the economy. It's over $12 trillion in U.S. debt in mortgage financing. So it's a huge piece of the economy. We need this loan to be able for people to buy houses. Now, beyond the mortgage, beyond the past the mortgage is the retirement. People do not have the ability to foresee the retirement and the costs and what it's going to look like. So normally the 30-year fixed rate loan, it was developed in the 30s that you get it when you buy a house and you pay it off by the time you're 60 years old and your house is owned at retirement. You won't have a mortgage payment. That's not the case as much anymore. At this point in time, more people are focused on your payment and what that payment actually is, right? So you get the loan, and if interest rates go down, you refinance the loan to get your payment down for the immediate need. But that starts the 30-year fixed process all over again. At the end of the day, households, they're not saving enough for retirement, and they still have their mortgage payment when they're retiring. I don't want to have a mortgage payment there when I'm retiring. So what do? We basically finance it, and then we refinance it to get that payment down, and it's still there. It's still there in retirement. There's a lot of things that go on during the life of a mortgage. I know this sounds a little bit funny, but at the end of the day, when you buy your house as a first-time home buyer in your 30s, late 20s, early 30s, you are going into the highest income earning years for you and your job. So you're going to earn more and more income, but you're also going to have a lot of things that come up. You're going to have kids. You're going to have expenses for kids. You're going to have college tuition that comes into play. You're going to have healthcare costs that you're going to have to deal with parents, with siblings, whatever it is. There's going to be a new roof on your house. There's going to be things that come up during those high income earning years when you do have a mortgage and you own your house. Now, a big piece of your debt is your mortgage payment. It's 42% of your overall debt. It's your biggest expense that you have, and you have to focus on this. This is something, people actually, they go and they look at it and they're like, oh, let's go through my expenses and see what I can really cut back to save some money each and every month. So they look at their cable bill, they look at their cell phone, they look at their utilities, they look at all those things. Use less water, use less electricity, all those things to lower it down. And those are small pieces of your overall debt. Your mortgage is 42%. And of that 42%, you pay a huge piece of that in interest. Most of that payment is going towards your interest, especially in the first 15 years of your mortgage payment. So why do we look at this and see that it's such an important thing? And the 30-year fixed rate piece of this loan is a great loan. I do this loan. I offer a 30-year loan. A lot of the loans that I do are these 30-year loans. But at the end of the day, there's positives and negatives to the 30-year fully amortizing loan. It's low down payment. You can do 3%, 5% down on this mortgage. It's very flexible. It gives you, it's not flexible, it's familiar. It's familiar to you. Every time somebody calls me up for an interest rate, I know that they're calling for an interest rate on a 30-year forward amortizing loan. It is readily available for you. You know that there's a 30-year fixed rate loan out there, and it's available and it's easy to get to. And it's payment dependent. So you know what that payment is going to be month in and month out on your mortgage. You know exactly what it's going to be. It's very dependent each month that you're going to have that mortgage payment. But the cons of this is that it's slow. It takes decades to repay, not only 3 decades, but sometimes 4 or 5 decades to pay it back because you refinance and start the 30-year process over again. It's inefficient. The interest costs are all front-loaded in the repayment of this mortgage, and I'll show you this in just a second. It's rigid. You cannot get to your equity. You can't take your money out. And it's very expensive. Expensive up front because all of that front-loaded interest is there, and normally you're going to pay all that interest up front. So this is an example of an amortized loan, right? So the gold piece of this loan is your interest. The black is your principal that you're paying. And yes, this is actually how it starts from day one on your mortgage. You're going to pay the first 8 to 10 years, 8 years, let's call it 8 years, 80 to 90% of your mortgage payment is going towards your interest cost. So if you paid $1,000 for your payment, $900 goes to interest, and $100 goes towards your principal. you're doing that for the first 8 years. Now, you get to year 15 and you think you've paid your mortgage off by 50%. That's not the case. You've paid 70% interest, and in year 21, now you have 50% of your unpaid principal balance that you need to pay off. So once you get to that point, you're making mostly principal payments during that year 21 through 30, but it's getting there. That's the key. So you pay a lot of interest up front on this loan. In fact, on a 6% interest rate loan, you're going to pay about $116,000 in interest, 116% in interest, or $116,000 for every $100,000 that you borrow on that loan over the 30 years. Even on a 3% mortgage, it's going to cost you 52% interest, or $52,000 in interest for every $100,000 that you borrow. So it is a big, big, big deal. Look, this is a simple math equation for the mortgage. It's your interest rate and your principal balance and your time. It's those three things put together to make up your mortgage payment. And normally you're going to have all those three things. You have the 30-year amortized payment. We're going to take this and I'm going to show you how to focus on your principal and your time in order to pay back that mortgage much, much faster. So the all-in-one loan, it pays down your loan 2 to 4 times faster, and I would say that normally in most of my instances I'm showing people how they can pay it off in 15 years or less. And it reduces your monthly and lifetime payment by tens of thousands of dollars. In California, I'm going to say hundreds of thousands of dollars in interest costs that you're going to save, and it gives you access to those dollars when you need them. So as you pay it down, you're going to have access to that money. How do we do this? We do it with the all-in-one loan. The all-in-one loan combines your mortgage with your bank account. We give you a new bank account. It has all the same features that you have in your bank today. It has your online banking, it has your online deposit, it's got your checking accounts. Everything that you have today, you have access to do with this loan. So the checking account, why is this super important that we combine the mortgage with your checking account? It is the birthplace of your net worth. So what do we mean by that? Every dollar that you earn goes through your checking account. In fact, if you put in 5 years, you're going to put more money than what you owe on your mortgage. So if you got $1 million mortgage, you're going to put more than $1 million net through this checking account. What do I mean by net? That's the cash that comes through. This is after tax income goes through your checking account. You're going to put more than $1 million through that account. It's the birthplace. It's where all your money goes and sits before you put it in other places. You spend bills or you pay bills or whatever you do. The problem with it is that it floats in there for days on end, right? Sometimes days, sometimes weeks, sometimes quarters, sometimes years that it actually sits in this account, not earning any interest whatsoever. What do I mean by that? Well, you're going to pay your bills, like I said, weekly, monthly, quarterly, semi-annually, annually. It's things that come up over time. The money is going to be sitting in your account. You're going to be putting it you're going to be saving it there, and it's going to be sitting there. But while it's sitting there, the bank is actually using that money for you, right? But unfortunately, you don't earn any interest on that. The bank earns the interest. So what do I mean by that? Well, that's what the bank is there for. The bank, they make their money by you depositing money into their account, and it's sitting there. And when it sits there, the bank uses it to lend it out for car loans, credit cards, installment loans. Anything where they can charge interest, they are going to lend it out. That's why you become a gold client when you put more and more money into that account. And they don't pay you very much for interest or interest on that money, if anything at all, on that loan. So what's different? Well, the only thing different, which is an addition to the bank account that we give you, is a sweep account. That sweep account is the money sweeping back and forth in your accounts. So the money comes into your checking account and it sits there for about a few hours, right? At midnight every night, what it does, When you deposit money into that account, it actually sweeps it over and pays down your all-in-one loan, your line of credit. It pays down that loan so that you can pay less interest on your mortgage. What do I mean by that? Well, on this mortgage, it is not a forward amortizing loan. It's not a monthly payment that you have. It's the only loan that re-amortizes every single night. It re-amortizes every night, recalculates what the interest cost is going to be every single night based on your balance. So what we do is we take that nightly principal balance, so whatever the balance is, times the interest rate, divided by 365 days. That's your interest cost for the day. We mark that in your account. We put it in the memory. You don't have to do anything with it whatsoever. It happens automatically. It does this every single night based on whatever your balance is for that day, and it charges you that interest cost for that day. On the 21st of the following month is when you're going to have that interest charge. And that's when we charge you that amount on your loan. You do not have a principal mortgage payment every single month. Every deposit that you make is your principal mortgage payment that you make on this loan, and you just have the interest cost that you have. Now, what happens when all that money is swept over to your HELOC, your line of credit? It's there, it's available. And when you pay your bills, you log into your bank account, you don't see any money in your checking account. It's all in your line of credit that you have. So you can still pay those bills when you do your online payment. You pay your car bill, you pay your utility bill, whatever it is, and it comes in to get cleared into your account. And it says, shoot, there's no money in your account. So it automatically goes over to your line of credit and sweeps over the money back over to your account and pays those bills for you and clears those bills for you. Now, I said this before, I want to make sure that you know that this bank has every single thing that you have today. It's got the ATM, it's got the personal checks, it's got the online banking, it's got the mobile banking, it's got the client services. Everything that you have today, it has. It is just a first lien line of credit that we give you, and we combine it with a sweep checking account to be able to use. Now, this line of credit, it's not your normal line of credit. Normally you have a, let's say you have a line of credit on your house. Normally it's a 5-year draw with maybe a 20 or 25-year repayment on that loan after you can draw on it for that period of 5 years, and then you have to pay it back over those 25 years. This loan is a 30-year line of credit. You can have access to it for 30 years. Now, we give you the full amount. Let's say that we gave you that $1 million loan for this. We give you that full amount for the first 10 years. After the first 10 years, what we do is reduce that amount by about 5% every single, 25% every 5 years, or about 5% every single year. So at the end of the 30 years, we want you to have paid this off. We don't want you to have a line of credit that you get out of control and you do not pay it off over that period of time. Now, the cool thing about this loan is that you can pay it off. You can pay it off sooner, where you're not paying any interest on any of the money that you're not using. So in this example, you can pay it off in 15 years, 10 years on this example, or maybe you have some expenses that come up. So college tuition comes up because your kids are now going to college. You want to write a check. You don't have to apply for any loans. You can just write the check out of the equity in your account, right? Because you paid it off in 10 years rather than 30 years. You may want to buy another rental property. So you can buy the rental property, you can put a down payment on it, you can pay it off. Maybe you're getting older and you have medical expenses, and so you have to pay for some medical expenses. But it gives you that flexibility in order to use the money when you actually need to use the money. So at the end of the day, it's the all-in-one loan. It's all in one account. It gives you, you can online banking, you can use your app on your phone, and you have your checking account or your statements that you want to have at the end of each month on this loan. So look, this is the all-in-one loan. It is a very, very flexible loan. It gives you the opportunity to pay off your loan a lot faster, save tons of interest. Now, excuse me, as I go into this, I want you to point you to a video on the simulator. There is a video on the simulator. It's going to show you how you can do this, how you can pay off your loan a lot faster. It's going to compare it to a 30-year fixed rate mortgage and what that actually looks like. But if you want to look at that specifically with your numbers, your income, and your expenses, I can help you do that. I can go through the numbers and go through that with you. If you want to spend some time more going over the presentation, I can do that as well. But this is the all-in-one loan. This is the product that I love. It's the product that I have on my house, and I want you to experience this loan as well. So hopefully you understood the product, and if you have any questions, please feel free to reach out to me and let me know if you have any extra questions.